L Rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
This is L Rolls reporting from the Forex Super Model building, where I'm about to interview Professor Code down in the lab on the subjects of Forex gears and front and backdoor flows. Welcome to the lab. Let's have a quick recap. The Forex Super Model is based on the major four currencies: dollar, euro, yen, pound. Those four currencies are converted and called complexes. A complex is made up of three FX pairs which combine the other complexes. You then calculate the net movements of flows from a particular period of time. Our current example is the week the 18th of the 10th. Oh, didn't even put that there. 2020. Now, if you find the net flows, you end up with net figures. Then the next thing is you bracket them and you assign names and values to them. And in this case, this is where we are. So we've got the dollar, in this example, was -348. And this was the largest figure, positive or negative, so we assigned it as the driver. Now in this case it's the negative driver, it's on the negative side of the brackets. Now if you remember, the secondary driver is the one at the far opposite end with the opposite sign. So in this case the euro at +230 is the secondary driver, and it's the positive secondary driver in this case. The rock is the complex which moves the least. In this case it's the yen, -75, stick an R in there for rock. And the one that's missing is automatically the mover, M. In this case it was the pound, and it was a positive mover at 193. Now, we then looked at the extremes and we said that in this case the dollar was the negative driver, but it was opposed. So it's the negative opposed driver, or the opposed negative driver, and it's opposed in this case by the yen because there's something else on the negative side. Now, you can have a situation where one currency or one complex currency completely dominates, either positively or negatively, and then it becomes the unopposed positive or negative driver. So you get one thing in here and the other three that side, or the other way around. That's as far as we got. We're now moving on to the next stage, which is we're going to be looking at front and backdoor flows. Now what do I mean by that? Now in this example, basically front door flows are from the driver to the other side. So in this case, front door flows are to the pound, and they're also to the euro. So these are front door flows. We call them front door because they're from the driver and they go into the other complexes. Now, you only get front and backdoor flows together when you have opposed drivers. If you have unopposed drivers, you just have front door flows. I'll explain that later. Now, so the front door flows here. So people were selling the dollar heavily to the tune of 348 points during the week. As we know, there's a circularity of flows, so negative flows coming out of the dollar have to go somewhere, and they're going in to predominantly the euro, which is the positive second driver, and then secondly, not far behind in this case, the pound, which is the mover, the positive mover. So they're the front door flows. Now backdoor flows come from the following. So they come from, in this case, backdoor flows come from the yen. So this is backdoor flows. So remember, this is the opposed negative driver in this case, the dollar. So the bulk of the flows were coming out of the dollar, but we also had some flows coming out of the yen. They're the least flows because they're the rock, but nevertheless they are negative flows. So in other words, the dollar didn't have selling all to itself. The yen was selling off a little bit as well. Now, because the yen was selling off, some of those negative flows had to go somewhere, and they'll be going into positive complexes, which are, in this case, are the pound and the euro. Now, by definition, backdoor flows will be smaller than front door flows. The ratio of those flows depends on how these complexes set up. So you can get a situation, for example, if we had minus 348 there, we could have had minus 300 on the yen, in which case it would have been very evenly balanced, and you'd have had significant backdoor flows as opposed to minimal backdoor flows in that case. Now, you can obviously write this the other way around. So if we had, like, if the euro, if we'd set this up differently, and let's suppose the euro was the opposed positive driver, then we'd be looking at this in reverse, and we'd say that the front door flows were coming from the positive euro and driving into the dollar and the yen, which would be negative in this case, and the euro would be opposed because the pound would also have a few positive flows, and they'd be backdoor flows flowing into the dollar and the yen in this case. Now, that's important because when you're trading, it's important to understand whether you're dealing with front door flows or back door flows. And when you're in a long-term position or a medium-term position, particularly if you're trying to scale it, you need to understand what these flows are going to do to the individual complex, to the individual FX pairs and the complexes. So that's where we're at. And if we think about it in and break it down a little bit further, I'll just get rid of this so I've got room. Then the driver to the mover and the secondary driver are front door flows, and the rock to the mover and the secondary driver are backdoor flows. So this is front, and this is back. And the easiest way to remember it is people's front doors are normally, if you've got a large house, stately, think of it in terms of a stately home, they've got enormous front doors for the important people to come in, and they've got very small back doors for the riff-raff tradespeople to come in, like myself. That's a good way of thinking of it. Right, so we've got a situation there where we can now recognise front door versus back door flows. Now, I'll show you why the final bit which I alluded to. Let's just get rid of this. Let's suppose we've got an unopposed negative driver of the dollar. So we've got pound, yen, euro. So this is our negative driver. Everybody's bailing out the pound, the dollar, sorry. Everybody's bailing out the dollar. Okay, for whatever reason. Could be an interest rate decision, could be massive risk on. Who cares? They're bailing out the dollar, right? To the exclusion of everything else. Now we know that the opposite one will be the secondary driver. So we've got a positive secondary driver, we've got a positive mover, and we've got a positive rock. Now, all these, remember the driver is the front door flows. So all these are front door flows. So we've got front door flows out of the dollar into the pound, the yen, the euro in this case. Now, we don't have any backdoor flows because there's no opposing flows in this case. We're at an extreme. And you can have the equivalent extreme the other way. So if you have an unopposed positive driver, you've got the equivalent going the other way. Now this is important to be aware of as well, because if this situation were to develop after a major fall in the dollar, supposing the dollar had been dropping, and then we had a daily or a weekly reading that gave us this situation, then this would more than likely represent a flaw in the dollar because it's an extreme. If we hadn't had a big fall in the dollar and we were just getting going, this could represent a build-up of negative dollar positions and represent a continuation and the start of a major dollar downtrend. Now that is very useful information. It's critical information and very important to grasp, and we'll talk about this in future videos. But anyway, that's where we are. So you only get front and backdoor flows when you have an opposed positive or negative driver. When you have an unopposed driver, positive or negative, you only get front door flows. Right. The next thing we're going to go on to is FX gears. Now, the modelling, we have what's known as modelling gears. Let me just get rid of this. So let's see what we're doing. Right, so FX, complex, gears. Now, in the same way, if you're driving your car, unless it's an automatic, in which case you're not too bothered, but if you're driving a manual gearbox, you need to understand what gear you're in. You don't drive down the motorway in first gear, and you don't do the opposite. You don't want to be in reverse either. So you need to know what gear the car's in. So we can use the modelling. An analogy of the modelling is to use it as a motoring gearbox. So first gear. So let's start off in neutral. So we're in neutral. And when we're in neutral, clutch down, wiggle it, yeah, we're in neutral, okay? Now, let's suppose we're talking the dollar complex. Doesn't matter what it is, but let's look at the gears of the dollar. Let's suppose that on the first reading of the complex flows, the dollar is the positive rock. So it's the positive rock. So, plus positive rock. That's our first gear. We're into first. The next gear is the mover. And the next gear, so we've gone to first, second, cross to third, and the third gear is the secondary driver. Right, we're in third, we're picking up speed now. Now, we end up fully driving the market into fourth. Right, so we're going into fourth and we're the opposed driver. Right, so we're in fourth, we're really getting going now, and we've got the open road ahead of us. Now, what's the final gear? Well, we need to get into overdrive, and the way we get into overdrive is we go into fifth, up the box, and it's the unopposed driver. So, that's fifth, fourth, third, second, first. So, likewise, we can move around this gearbox the other way. So we could be, let's assume that it's a bit of a peculiar gearbox. We've got 5 gears in reverse as well. Now, minus. So we've got the negative rock, then we're going even faster in reverse. We've got the negative mover, we've got the negative secondary driver, we've got the negative driver which is opposed, and we've got, finally, we're really shifting in reverse now, we've got the unopposed negative driver. So this is first in reverse, this is second, the mover's second, the secondary driver's third, the opposed negative driver is fourth, and the unopposed negative driver is fifth. So that's our gearbox. Now, we don't have to move up and down this gearbox in equal installments. As you know, if you're driving, you can be in first and then you can go from first to third, or you can go from fifth to second if you want. You can do what you like. And the Forex complexes move through the gears, and remember the gears are ascertained from the complex flows. The net complex flows are bracketed figures. So once you get to know what gear the market's in for a particular complex and what gear it's come from and how it's moving, it gives you a good idea of where it's going. So for example, if the dollar was the negative rock and then moved up to the positive mover and then went straight to the opposed positive driver, then it tells us, in the light of all the other information, the potential for it becoming the unopposed driver or reversing out or doing whatever. This is all very important information. So really this is the last stage. Forex gears is the last drop of pure modelling. It's the last bit of vodka. Remember the vodka. Anything else than this, so we've got complex gears, we've got front and backdoor flows, We've got whether it's the rock, the mover, the secondary driver or the driver. We've got whether it's opposed or unopposed, etc. All that is the pure vodka of the modelling. As soon as we get away from that, as I said, you're into bias and modelling for its own sake, and you need to be very careful because your models start to have a real bearing on what's going on in terms of your trading. And not only that, but it starts to have a variance between what's happening in the real market. This is factual. This is just a way of stating what's actually happening. So we've got basically an input from a date going into a box which gives us the Forex Super Model in terms of, that's our vodka. And from there, we're into the rest of the modelling, which we've not talked about. And that's where the big question marks are. So basically, that's where we're at in terms of the process. So moving on from there, in future videos, we're going to talk about the relationships of these core principles in terms of real life situations, and we're, on a daily basis, I'm going to be using this framework to explain how we can predict not only long-term moves in the market but short daily to swing moves in the market, which I know a lot of you are interested in day trading. It's not really our thing. Having said that, there are some excellent opportunities for day trading, and we are sort of theoretical day traders in a way, because if we get a full grip of the daily moves, it helps us when we're scaling and into the bigger moves. But we'll talk about that later. Now I'm going to leave it there, and I hope this was relatively clear for you. Mac D brokers. As I always say, the most important thing is to be calm when you're trading. No matter what the market throws at you, keep your presence of mind and serenity. Now, we've just received a fax from the lab. It's here somewhere. Here it is. It's the latest brain scan for the Techno Monk. This is Al Rolls reporting from the Forex Super Model building, about to interview the risk manager on aspects of Forex gears. Welcome, trading cats, to the Risk Mobile. Right, into first, which is the positive rock. Positive mover. Off we go, gaining speed. Into third, which is the positive secondary driver. Into fourth, which is the opposed driver. Into fifth, which is the unopposed positive driver. Looking to make a right turn. Down into the opposed positive driver. Down into the secondary driver. Into neutral. Positive rock. Positive mover. Positive secondary driver. Double D clutch into the positive mover. You did. This is Al Rolls signing off from the Forex Super Model building.